Welcome to this new video where we're going to talk about the end-of-month rally. First of all, let's take a look at what exactly the end-of-month rally is. This is one of the best-known seasonal anomalies in financial markets. In this specific case, I'm mainly referring to stocks, so individual stocks and market indexes. More specifically, what we can say is that returns tend to cluster around the final trading days of the month and the first trading days of the following month. And that's exactly where the name end-of-month rally comes from, also known as the turn-of-the-month effect. The fact that market performance tends to concentrate within this small time window has been demonstrated by numerous studies. In fact, you'll easily find articles, trading strategies, and even academic papers discussing it. And as always, I encourage you to explore those resources because they're a great way to discover new ideas, new methodologies, and ultimately gain a deeper understanding of financial markets. But it's not just articles and academic research. We also have a reference video published on this channel about 7 years ago, where Unger demonstrated how this effect actually exists. And I also encourage you to go back and watch that video because it didn't just analyze the phenomenon itself, it also introduced a strategy based on a specific pattern designed to exploit this anomaly in financial markets. In today's video, however, I want to go deeper into this seasonal effect and understand whether it still works over a broader historical period, including the out-of-sample phase, meaning the years since that original video was published. And most importantly, I also want to understand why this seasonal effect might exist in the first place. So let's start with a simple analysis. Here, as you can see from this chart, I've plotted the average daily returns by day of the month for the Dow Jones index. Why did I choose the Dow Jones instead of something like the S&P 500 or the Nasdaq, which today are generally considered the main benchmark indexes? The reason is simple. Dow Jones data goes all the way back to 1910, which gives us a much longer historical record for analysis. As for the chart itself, on the vertical axis, we have the average daily return expressed as a percentage, while on the horizontal axis, we have the trading day within the month. One thing you'll notice is that I didn't simply label the days from 1 to 10, 20, and so on. Instead, we're using a day counter relative to the change from one month to the next. So, in this histogram, the red section represents the previous month, while the blue section represents the new month. For example, -1 represents the last trading day of the month, while +1 represents the first trading day of the new month. Another important detail I want to point out is that we're talking about trading days, not calendar days. Weekends have been removed because stock markets are closed on Saturdays and Sundays. So what can we conclude from this chart? Well, we can clearly see that returns do tend to cluster within this narrow time window. If we look at trading days farther away from the turn of the month, average returns tend to be either slightly negative or fairly weak. The same applies starting around the 5th trading day of the new month. There really isn't much happening in terms of returns. On the other hand, from the second to last trading day of the month through roughly the 4th trading day of the new month, returns become much stronger. At this point, let's analyze essentially the same data, but in a little more detail. Here I've plotted the same average returns by day of the month, but this time divided into 3 different market regimes, or more accurately, 3 different historical periods. Specifically, I divided the historical data into 3 segments of roughly 40 years each. The red line covers data from 1910 through 1950. The blue line covers 1950 through 1990. And finally, the third period goes from 1990 through today, approximately another 40 years. So what can we conclude from looking at these curves? Well, returns have remained relatively consistent across all 3 periods, from the second to last trading day of the month through about the 4th trading day of the new month. Returns have generally remained positive. There is, however, one important point to consider. Starting from 1990 onward, we can see that the final trading day of the month actually turned negative. In fact, if we only analyze this most recent period, it would appear to be the worst day. So does that mean it no longer makes sense to hold positions on the final trading day of the month because post-1990 data suggests otherwise? Personally, I don't think so. When analyzing statistics like these, we always have to remember that some data points will inevitably be influenced by extraordinary events. Take the tragic September 11th attacks, for example. The returns from that specific day will influence virtually every statistical analysis, strategy, and market study. But that doesn't necessarily mean a strategy stopped working simply because it was affected by an unpredictable event. So we need to be very careful when interpreting data like this. With that said, let's now see how a strategy focused exclusively on this specific time window would have performed compared to a traditional buy and hold approach. And we can see that in this chart. The gray line shows the performance of a simple Dow Jones buy and hold strategy. The blue line represents a strategy that remains invested from the second to last trading day of the month through the fourth trading day of the new month. And we can clearly say that this strategy outperformed buy and hold not only in terms of returns, since it generated higher profits, but also in terms of risk and drawdown. For example, during what was probably the most violent stock market crash in history, the 1929 collapse, the strategy certainly experienced drawdowns, but they were much more contained compared to buy and hold. The same applies during other periods, for example here, or during long sideways market phases that lasted years or even decades. The strategy held up surprisingly well. We can also see resilience during the dot-com crash, and looking at more recent periods, take 2022. That year brought a prolonged bear market lasting several months. And yet this strategy still performed relatively well. Another interesting aspect to analyze is the strategy's performance during the most recent years. For example, if we focus on roughly the past 15 years, we can see these two curves starting to converge. What I mean is that buy and hold appears to be catching up and performing better than the strategy. That observation could easily lead someone to conclude that the strategy has stopped working and that the edge no longer exists. Now, of course, that's possible. None of us has a crystal ball. But personally, I think it's still too early to say that. Take this section here as an example. You can see how buy and hold significantly outperformed the strategy, while the strategy itself remained mostly flat. If back then we had jumped to the conclusion that the strategy had stopped working, we would have missed the strong returns that followed in the decades afterward. So yes, over the past 15 years, buy and hold has delivered stronger returns, but that doesn't automatically mean the strategy has stopped working. Another aspect I want to focus on is the performance during 2008. Here we see what is effectively the strategy's second largest drawdown after 1929. And going back to what I mentioned earlier, it's entirely possible that the poor performance observed on the final trading day of the month was heavily influenced by what happened during 2008. So once again, it doesn't necessarily mean the final trading day of the month is inherently negative. It may simply have been impacted by extreme outliers and extraordinary events like those we experienced during the 2008 financial crisis. Now let's move to what is probably the most important question surrounding this strategy. And it's the same question I ask myself. Why does it work? Why should this seasonal effect even exist? Over time, several theories have been proposed. Here I've included what are probably the two best-known explanations. The first involves recurring capital flows. Think about salaries, retirement contributions, or recurring investment plans. These are capital flows that tend to occur on regular schedules. Another possible explanation involves institutional portfolio rebalancing. Imagine a portfolio strategy where you keep positions that are performing well and remove those performing poorly. That rebalancing process will very likely happen around the end of the month or the beginning of the next one. Unfortunately, despite all these theories, we still don't have definitive proof explaining the true cause behind this phenomenon. For example, if these moves were truly driven by institutional money flows, we would probably expect trading volumes to increase significantly during that specific time window. Average volume should be noticeably higher. But in reality, that's not what we observe. As for recurring capital flows, we also need to remember that we're analyzing more than 100 years of market history. Now, personally, I wasn't trading markets back in 1910. But it's difficult to believe that retirement contributions, salary schedules, and investment plans worked exactly as they do today. So ultimately, even today, there is still no universal agreement regarding the precise causes behind the end-of-month rally. It could simply be a market anomaly, or it could exist because of a combination of factors like the ones we've just discussed. What remains interesting, however, is that this edge could potentially become useful within a well-diversified portfolio. With that said, let me know down in the comments why you think this seasonal effect has persisted throughout such a long historical period, and why it might continue to exist in the years ahead. And I'll see you in the next video.